Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
All right, let's dive right in. We're looking at RZLV PLC, ticker RZLV, and it is, well, it's probably the single most contentious small cap tech stock on the market today. It's a true battleground defined by this extreme asymmetry between its aspirational claims and the cold, hard financial reality.
It really is, and that tension it's palpable in the market microstructure. I mean, you're looking at a staggering 21.15 million shares sold short. That is roughly 17% of the publicly available float.
Yeah.
And what makes it so explosive is the daily volume. It often pushes above 15 million shares. So you have this constant liquid battle between, institutional bears and speculative retail money.
Exactly. So the central question we have to tackle is this. Is RZLV fundamentally a misunderstood vanguard of what they call agentic commerce, a disruptive tech that's actually poised to hit, 500 million in annual recurring revenue by 2026? Or is it just a financially toxic structure, repeating a historical pattern of value destruction? I'm going to argue for the potential, both in the tech and in the technical upside from that short position.
And I'll be focusing on the structural flaws, on the profound and, frankly, historical governance risks, and the reliance on what I see as predatory financing that, well, it suggests this whole thesis is untenable, regardless of what the tech promises.
Okay, so my starting position absolutely acknowledges the high-risk profile here. You can't ignore it. However, I think the current market skepticism is blinding investors to the potential of agentic commerce. And this isn't just, another generative AI for retail. We're talking about the autonomous negotiation and execution of transactions by an AI. Think of AI agents that proactively manage complex purchases, fulfillment, completely bypassing the old digital storefronts. That disruptive scope is what justifies those aggressive targets, 100 million ARR in 2025, and then the big one, 500 million by 2026. And, beyond that, the immediate catalyst, the thing that could move the stock tomorrow, is precisely that massive short interest, over 20 million shares.
Right.
Now, the days to cover is pretty low, but the sheer volume of bearish bets means any positive news, a partnership, a minor earnings beat, anything, it could trigger a volatility-induced technical squeeze. That technical event could just override all the fundamental concerns in the short term. And look, the strategic partnerships they cite with Microsoft and Google, even if they're just vendor relationships right now, they still provide some market validation.
I see it very differently. That aspirational valuation is, to me, completely irrelevant if the foundation of the company is rotten. The thesis is just fundamentally flawed because of these historical governance risks centered squarely on the CEO, Daniel Wagner. We have to use his history as a predictive framework. We have seen this exact pattern before: high-velocity promotion, huge fundraising, and then catastrophic collapse.
The Power example?
Exactly. Power Technologies, a $2.7 billion UK unicorn that just dissolved. Or Made Dialogue, which saw a 95% share price collapse. This history suggests the pattern of raising capital that just fails to translate into a sustainable business. And that pattern is repeating itself structurally inside RZLV, most alarmingly through offshore payments. Corporate filings show Resolve transferred approximately $93.9 million in share-based payments to an entity called DBLP Seacow Limited.
The Seychelles entity.
The Seychelles entity controlled by Wagner. Now, when a company with less than $200,000 in annual revenue makes a transfer of that size to an executive-controlled offshore entity, that is textbook self-dealing. It completely divorces the founder's wealth from the company's success. His incentives are aligned with issuing stock, not generating profit for shareholders. And I'm sorry, I just cannot buy that $500 million ARR forecast. Let's really scrutinize the quality of the revenue. Resolve 2024 revenue was minimal, mostly from Kibble Spa, football ticket sales, not the agentic AI revolution. The growth they're projecting relies entirely on inorganic means, acquiring established and frankly often declining legacy tech providers like Visenze and GroupBuy. This is the mispricing issue. These are roll-up acquisitions of legacy SaaS revenue which the market values at maybe 2 to 4 times sales. Resolve wants a 20 or 30 times multiple, something reserved for pure play, high growth, organic AI.
Okay, I appreciate that distinction between consolidation and organic growth. But I'd frame those acquisitions as critical strategic moves, not just buying distressed assets. The market is buying into a platform strategy, and that requires immediate scale. So the roll-up is a necessary, calculated step to acquire foundational customer relationships to get the data infrastructure you need to actually deploy the agentic AI platform. I mean, acquiring Group I gives them sticky relationships with major retailers like the Container Store. That lets them bypass years of slow, expensive enterprise sales cycles. These acquisitions provide the baseline they need to commercialize their proprietary tech. It's a land and expand strategy built on a purchased foundation. And let's talk about that technology, because that's where the real long-term value could be. Management asserts their proprietary BrainPower LLM provides a defensible moat. Specifically, they claim it solves the industry-wide problem of LLM hallucination, the AI confidently making things up. They say this makes it safe for high-stakes enterprise commerce. And if that claim is true, if they have solved hallucination, then that is the core IP that justifies the entire valuation.
But I am just not convinced by that line of reasoning, because the technical due diligence strongly suggests BrainPower is what we'd call a wrapper, a sophisticated UI built on top of third-party models, like OpenAI's GPT. And that has profound financial consequences. If the core logic is outsourced, RZLV has to pay huge API costs for every transaction. That structurally caps their gross margins. It means there is no proprietary defensible advantage. Any competitor could just license the same foundation models and build their own interface. And worse, there are reports that the model explicitly admitted to hallucinating during testing, which directly contradicts their central claim.
That's a compelling point on the margin pressure. But a wrapper can still hold significant value if the data and optimization layers are unique. They're not just calling an API. They claim to be using proprietary mechanisms to filter and constrain the output for commercial certainty. The focus is on the implementation and the domain expertise, not the foundation model itself. Retailers need certainty. If RZLV delivers that, they won't care if it runs on GPT-4. That proprietary grounding layer, if it works, is the moat.
Okay, technical feasibility aside, we can't ignore the immediate financial fragility here. They reported a net loss of over $12.8 million in the first half of 2024. That is a completely unsustainable cash burn with almost no organic revenue to cover it. This forces them to rely on these structurally detrimental financing mechanisms, especially the Standby Equity Purchase Agreement, the SEPA, with Yorkville Advisors. We have to break this down.
The death spiral.
It is a classic death spiral. The financier buys shares at a discount 4 to 10% below the lowest volume-weighted average price during a set period. This mechanism creates a direct financial incentive for Yorkville to actively short the stock to drive the price down. The lower the price, the more shares they get for their money, which they then immediately sell into the market. It ensures continuous institutional-level selling pressure and relentless dilution for every single shareholder. It's built for capital extraction, not growth.
I see why you characterize it as toxic, and that's a great explanation of the mechanics, but I might frame their actions differently. Their decision to fight back, the litigation they filed against Yorkville in August 2025, that can be seen as management trying to defend its shareholders from that exact predatory pressure. They're trying to break free. Furthermore, the high daily volume, over 15 million shares, it does provide liquidity. And while that means shorts can cover easily, that liquidity can reverse violently if a breakthrough occurs. That's the whole retail short squeeze thesis right there.
And beyond that, the company has shown this consistent, maybe opportunistic, agility in pivoting its narrative. From mobile commerce to crypto with that Tether partnership, and now agentic AI. This adaptability suggests they can keep securing capital long enough for a major commercial breakthrough to finally happen. They are, if nothing else, survivors in the capital markets.
Against your own bank of last resort is proof of a fragile liquidity position. And we haven't even touched on the severe legal and regulatory risks. Class action lawsuits are piling up, alleging false and misleading statements about ARR and AI. And the most alarming thing, this bizarre allegation that management tried to move investor cash in Bitcoin to Kazakhstan. That's not just poor governance. That raises profound red flags for money laundering, for SEC scrutiny. It's an existential enterprise-ending threat that overshadows any AI story.
Okay. We've certainly examined both sides of this explosive equity, covering the squeeze potential, the growth story, the financial fragility, and the huge governance risks.
So to summarize my position, the synthesis of the governance history, Wagner's predictive pattern of failure, that $93.9 million payment to an offshore entity, and the reliance on this relentlessly dilutive financing, it all fundamentally undermines any technology narrative. It paints a very consistent picture of a promote destined for permanent capital loss.
And my summary is that we have to recognize the unique dynamics here. The sheer scale of the growth targets, combined with the extreme technical positioning of that short interest, offers a genuine, if highly speculative, lottery ticket scenario. Investors have to weigh a definitive historical pattern of failure against the possibility of a market microstructure event, a severe short squeeze that can momentarily validate the valuation and drive massive short-term gains.
And that is the crux of it. It forces investors to decide if they're betting on fundamentals, which the forensic accounting suggests are toxic, or if they are betting purely on market microstructure and technical momentum, which is just volatile and unpredictable.
It is an extremely difficult assessment, and it really proves that the material contains ample evidence to support a much deeper exploration into this intense financial and technological complex.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching, and see you next video. Bye-bye.